There are bull markets and bear markets, and in basically any tradable instrument or commodity, or I consider gold to be a form of money. But what we're really talking about when we say, gold is up, what we're talking about the dollar price of gold. And I view it as a cross exchange rate. People talk about the dollar, the euro dollar exchange rate. The euro is now $1.17. Well, there's a dollar gold exchange rate, and that's the dollar price of gold. So they're just alternative forms of money where people get to express a liquidity preference or a credit preference, if you will, if you're concerned about if you're losing confidence in the dollar. But the first great bull market was 1971 to 1980. It lasted 9 years, and gold went up 2,200%. The second great bull market was from 1999 to 2011. Gold went up at just a little under 700%. But in between, you had a bear market from 1980 to 1999. It's a long one, almost 20 years. Gold dropped from $800 to $250 at the bottom in 1999. The bear market started in 2011, but it really fell off a cliff in 2013. Gold's going to the moon, but nothing goes to the moon without a 50% correction along the way. And if you look at the high in 2011, $1,900, approximately, and where was the bottom of the bear market? It was $1,050 on December 16, 2015. Nobody knew it was the bottom at the time.
We're in the third great bull market in gold in history. When I say in history, you're like, well, gee, history is a long time. How come this is only the third bull market? Well, the answer is for almost all of history up until 1971, gold was money. So you didn't have bull markets or bear markets. It was just gold. And that was the money. And you thought about it by weight. You say, well, I'll give you an ounce of gold for this property, or I'll give you, a quarter ounce for, some food or groceries or whatever. So you thought about gold by weight. It was money, constant store value. So it's really only since 1971 when Nixon suspended redemption of dollars for gold by our foreign trading partners, that gold just went its own way, detached from the dollar. So the dollar would do what it was going to do, and gold had its own market and still does. The first great bull market was 1971 to 1980, and gold went up over 2,000%, from $35 an ounce to $800 an ounce in January 1980. Then there was like a long, drawn-out, almost 20-year bear market from 1980 to 1999. And gold dropped down to around 250. So it went from the 800 level down to 250. The second great bull market was from 1999 to 2011. August 2011, gold went from $250 an ounce to $1,900 an ounce. That was an almost 700% gain. Then the second bear market, August 2011 to December 2015. The third bull market, I can give you the exact date, December 16th, 2015. Gold hit $1,050 an ounce. That was the bottom of the second bear market I described, a pretty steep fall from the 1900 level.
But if you look at that drop down and you use $250 as your base, because you need a base, so you had basically the run from 250 to 1900 was $1,750. Go down 50% from there, it's $825. 1900 minus 825 is 1075, and the bottom was 1050. So Jim totally stuck the landing. Like at 1050, okay, there's your 50% retracement. Now that's the bottom. Now it's going up, and the sky's the limit.
Nothing goes from here to the moon without a 50% drawdown along the way. It'll get there, but it'll go up, down 50%, and then back up for the really big, sort of hyperbolic price move. We said, and you have to expect that. It's true of all commodities. Well, taking that advice, I then, looked at the charts. Well, starting at 1900, if you say, okay, it was 250 was 1999, 1900 was August 2011. That's the bottom, and it's up about 50% from there. Now, it's been a little bit higher than that, but it's up about 50% from there. So there's your third bull market. But here's the point, Robert. If the first bull market was up 2,000% and the second bull market was up 700%, so from December 2015, just using the averages, not anything crazy, 10 and a half years, up 1,500%, bingo, puts you at $15,000 an ounce in 2025. And by the way, don't wait. If you agree with that analysis, and there's more to back it up, don't wait until 2025. People say, oh, okay, well, it's going to be $15,000 an ounce. I'll go out and get it in 2024, I'll catch the wave. No, why not get the gold now, which I do recommend, and then enjoy all those profits. 1945, the law in the United States was the base money supply, M0, that's what the Fed controls, could be 2.5 times the U.S. gold hoard, the gold in our possession at the market. So taking originally $20.67 an ounce, later $35 an ounce, take the amount of gold times $35 an ounce, and whatever that number was, multiplied by 2.5, and that's how big the money supply could be. But so you can't go beyond that. But I actually talked to Ben Bernanke about this, because you hear over and over, the gold caused the Great Depression. Gold was the problem in the Great Depression. And I researched it, and actually the leading scholar after Milton Friedman was Ben Bernanke. And he showed with very precise detail that the money supply during the Great Depression never exceeded 100% of the gold. In other words, the money supply could have been 2.5 times greater than it was in the Great Depression with a gold standard. So gold was never a constraint.
I don't know if there'll be a gold standard or not, but I do know that gold will move, the price of gold will move in the direction of where it would need to be if you're going to have a gold standard. And I talked to Paul Volcker about this, and he agreed. If you just took the money supply, so just take M1, which is pretty widely accepted definition of money supply. Take it for the U.S., the ECB, UK, Bank of Japan, and People's Bank of China. There are other entities you could include, but that's over 75% of global GDP right there. Divide that number by the official gold, which is about 34,000 metric tons, a little bit less. You come to $15,000 an ounce. So if you're going to either have a gold standard or even use gold as a reference point for money, if you need to restore confidence in the dollar, the implied non-deflationary price is $15,000 an ounce. So what I find interesting is that if you use just the history of the last two bull markets and average them, or if you use a rigorous calculation, what's the implied non-deflationary price? Interestingly.